Ryan, and my colleague Lewis, who's one of our tax consultants here at PD Tax.
Morning, everyone.
Just a few quick things to run through before we get to the hopefully helpful and interesting content. What we're about at PD Tax is enriching lives by making tax simple. So the main aim for us is to make sure the clients are getting their tax and compliance correct, but also that they're paying hopefully as little tax as possible with due consideration to all reliefs and exemptions that might be available. Few areas that we advise on. It's not an exhaustive list. There's we pretty much deal with most areas of UK tax. Things like share valuations is something that you might not be aware of that we do. And we also offer a director service for accountancy firms where we can act as a cost-effective tax source for your clients. Yeah, just a little bit of general housekeeping before we begin. We're going to finish at 10 AM sharp, hopefully. Your mics will be disabled throughout, but you can ask questions through the webinar. And my colleague Laura, who is off screen but is attending, will be able to ask those at the end. If we do run out of time and we can't answer your questions, there is a breakout session after the webinar, and you can stick around, and me and Lewis will stay on for 10 or 15 minutes and you can ask some questions. But if not, we can also follow up with you. We can send you an email after the webinar, hopefully run through it. And then just a final point to say that this presentation is for general information only and doesn't constitute actual tax advice. So if you do have any tax issues, we would recommend that you seek competent advice from a competent professional. Okay, I'm going to pass you over now to my colleague Lewis, who's going to run through some of the finer points of staff benefits with you. Over to you, Lewis.
Thanks for that, Ryan. So firstly, I will be starting off with what staff benefits actually are and what this webinar is about. Employment income comprises of remuneration paid in monetary form, such as salaries and wages, as well as non-monetary income, such as staff benefits and share awards. Some of you on this webinar as employees will receive non-cash benefits, where most of these benefits are taxable. The taxable amount of a non-cash staff benefit is its cash equivalent, which is usually the cost to your employer of providing the benefit. Where an employee receives a benefit in kind, the employer will generally be required to submit a P11D form by the 6th of July after the relevant tax year, and pay the Class 1A national insurance contributions at 13.8% of the benefit by the 22nd of July. There are special rules to determine the cash equivalent of certain benefits, where Ryan will discuss how to value company cars later on in the webinar. Yes. So, due to changes that have come around because of COVID-19, a lot of employers are providing staff with certain equipment to enable their employees to work from home, such as IT equipment, telephones, and other related items. This is not a benefit in kind by the employer, where the reason for supplying the equipment is to enable the employee to perform the duties of the employment, and where the employee's private use is not significant. Similarly, a dedicated home telephone line or mobile phone can be provided to an employee specifically for business use, where this is not a benefit in kind if private use by the employees is minimal. So next, we will discuss the staff benefit where employers reimburse employees for mileage. Generally, a deduction will be given in arriving at net taxable earnings if an employee incurs an expense, provided it was wholly, exclusively, and necessarily incurred in relation to their employment duties. The general rule for tax relief on travel expenses is that any travel from an employee's home to their permanent workplace will be deemed as ordinary commuting, therefore tax relief wouldn't be claimable on this. However, reimburses employees for business mileage incurred using their own cars, the amount reimbursed must be compared with the tax-exempt limits set by HMRC. The relative limits can be seen on this slide, where if the amount reimbursed exceeds these limits, the excess is taxable. However, if it's less than the limits, the shortfall is deductible in calculating income tax. Some of you might be familiar with the following tax-exempt benefits. There is a statutory exemption from tax for trivial staff benefits. The cost of providing the benefit cannot exceed £50, and it cannot be provided in recognition of particular services carried out by the employee. An example of this could be where an employee receives a bottle of wine for passing an exam, where the gift is seen to be made out of the kindness of the heart of the employer. Christmas party or other annual functions costing below £150 per head are one of the most common tax-free benefits. HMRC also confirmed in 2020 that virtual events would also qualify for the exemption in light of the COVID-19 pandemic, providing that all the other conditions are also satisfied. If your company has multiple annual events, as long as the combined cost of the event is no more than £150 per head, they'll still be exempt. An important point to note is that the £150 is a limit and not an allowance. Therefore, if the cost is £151, the whole benefit will be taxable. In addition to this, these annual events must be open to all staff for it to be tax-free, where employees' partners can also attend. Further to staff parties, where an employer pays for or reimburses an employee for the cost associated with car parking at or near to the employee's place of work, this will be tax-free. At or near a workplace isn't defined in the rules. However, HMRC guidance allows exemption in any case where parking is within reasonable distance from the place of work. The exemption covers all vehicles, including bicycles and motorcycles, and it's important to note that the employer is not required to provide car parking spaces for everyone for the exemption to apply. So the cycle to work scheme. This scheme permits an employer to provide bicycles and associated safety equipment to employees tax-free. This scheme operates as a salary sacrifice employee benefit, where employees agree to give up part of their salary in exchange for the cycling equipment at the end of a loan period. The salary sacrifice is taken from gross salary before tax, which means that employees will pay less income tax and national insurance, and employers will also pay less national insurance contributions. For this scheme to be valid, the equipment must be offered to all employees. Ownership of the equipment must not transfer to the employee during the loan period, and the equipment must be used greater than 50% for journeys between home and workplace, or between workplace and workplace. After COVID-19, the government has eased the condition where existing users of the scheme are not travelling to work and may be unable to meet the condition for the 50% qualifying journeys rule. This relaxation will only apply until the 5th of April 2022 to employees who have joined the scheme on or before the 20th of December 2020. So due to the effects of COVID-19 in the current tax year, if you only need to work from home for one day in the 2021-22 tax year, you should be able to get a whole year's tax relief. The tax-exempt payment limit available to employees to cover the additional household expenses such as electricity or broadband is £6 per week for the current tax year. If payments are made that exceed this limit, these payments may still be exempt from tax, but the employer will need to obtain and keep records to support the actual costs incurred. If the employer does not wish to make the payment to their employee, the employee can personally claim tax relief through HMRC's online service or through their self-assessment tax return. As well as the work from home allowance, tax legislation was introduced to ensure there is no tax charge on an amount reimbursed to an employee in respect of home office equipment, where this was obtained for the purpose of enabling the employee to work from home during the pandemic, where this has been extended to also cover the 2021-22 tax year also. So then finally, in relation to your pension, the main ways of providing funds to your retirement are via personal pension schemes and occupational pension schemes. As this is a webinar about staff benefits, we will focus on occupational pension schemes. Relief is given on pension contributions to occupational pension schemes under net pay arrangements, where PAYE is applied to the salary after the pension contributions have been deducted from your salary. If an employer contributes to an employee scheme, this is a tax-free benefit, but it must be considered when looking at whether the annual allowance has been exceeded. Broadly speaking, pension contributions, both occupational and personal pension contributions, in excess of the annual allowance are subject to a tax charge at the individual's marginal rate of tax. The standard annual allowance is £40,000 for the current 2021-22 tax year. However, this annual allowance is tapered for high-income individuals, and it could be as low as £10,000, depending on your level of income. Furthermore, the annual allowance for the current year is increased by any unused allowance from the previous 3 years. And I think that brings me to an end. So before I pass it back to Ryan, we'll go through the poll. I think you're muted, Ryan.
Indeed, I am muted. Yeah, just to split up the webinar a little bit, we've got a quick poll there. So what do you think is the most valuable staff benefit provided by employers? The options there are employer pension contributions, company cars, company loans, share option schemes, which I'll cover shortly, company phone / laptops, or if you think it's something else, please feel free to provide to respond F. So I'll launch that poll now, and you've got 30 seconds just to cast your votes. Right, I think that's everyone that's answered, and I can reveal that the outright winner was with 62% was pension contributions, which I'm pleased that you responded with that, because I do agree that pension contributions are a very tax effective tool, and also a brilliant one for employees plan for their future. So yeah, thank you for that, Lewis. Covered some great and interesting benefits there. I'm just going to move on to my section now, if I can. Company cars. Company cars and fuel are probably one of the most popular benefits that we hear about. Whether one of the most popular benefits that are provided, I'm not too sure. But the benefit value of company cars is based on two figures. First being the list price, which isn't necessarily what's been paid for the car, and the second being the CO2 emissions. Maximum benefits 37% of the list price of the car. There is a supplement for diesel cars, so a diesel car will cost typically be 4% higher than its petrol equivalent in terms of benefit value, and those benefits are prorated for the availability during the tax year. So if you got it 6 months in, you should only have 6 months of the car benefit accessible on the employee. The employee can also make a capital contribution, but it can only reduce the list price by up to £5,000. So if they wanted to contribute, say, £10,000 to reduce the value of the benefit, it wouldn't be really worthwhile doing that, because realistically, it could only bring that list price down by £5,000. So if that's a conversation that you end up having, don't make sure they don't put any more than £5 towards the cost of the car. Now, fully electric cars carry a benefit in kind percentage of 1% for the 21-22 tax year. So it can be quite a tax effective benefit. If you got an electric car with a list price of £50,000, that annual benefit, if the car was provided for the full tax year, would be £500. That's what the employee would be assessable upon, and that's what the employer would pay Class 1A NICs on. So it can be really tax effective when the car is electric. For hybrid cars, there is a bit of a sliding scale, and there will be a lower benefit in kind percentage that applies where the hybrid car has a lot higher electronic range. So generally, it's going to be better when the employer is going to provide a company car to an employee. It's going to be better to opt for diesel over petrol, and it's going to be better to really to provide electric or hybrid cars, because it's going to reduce the cost of the employee and the employer overall. And I've also mentioned at the end that there's no benefit in kind where there's free charging points provided at the company workplace. And then just a couple of final things. The fuel benefit is a flat rate benefit. So if an employer provides £1 worth of fuel in a year, the employee could be subject to a flat rate benefit of £24,600 times the relevant CO2 percentage on the car. So it can be a really huge tax issue. So generally, if you're only providing a little bit of fuel, it might be advisable to advise the employer to repay that to the employee to repay to the employer to avoid that benefit being applied. There's no benefit for pool cars. Pool car would be a car that's available for all employees to use. It's not identified to a specific employee. So perhaps there's a car outside work that anybody can jump in and run errands in at a given time. There's no benefit to any specific employees on such a car. And company vans and fuel are generally a much smaller benefit in kind when compared with cars themselves. Moving on to employee share schemes. An employee share scheme, in a nutshell, is a means of incentivizing employees by offering them a practical and potentially tax-effective way of becoming shareholders in the company. There's 4 tax advantage share option schemes that I've listed there. By tax advantage, I don't mean that somebody's come up with this. I mean, they're legislated and HMRC approved schemes. So the tax advantages are there in tax legislation. And generally, the way that a share option scheme would work is that the employee would inquire an option, which is a choice to acquire shares a future period in a given window. And so they can decide whether they do want to acquire shares, or they can decide if they don't. And sometimes that can be subject to certain conditions. Share option schemes are used as a way to remunerate employees, as a performance incentive to try and get the best out of employees, and also as a way of retaining staff long term. And the reason that tax advantage schemes are better are in the absence of any tax advantage scheme, where an employee were to receive shares in their employing company, there would be an income tax charge based on the market value of the shares at that time. So it would be no different to the employee, really, if you were to give them £10,000 in cash remuneration, like a salary, or if you were to give them £10,000 in shares. So I'm going to focus on enterprise management incentives, or EMIS, because that's the scheme that we probably come across most often, and it's probably one of the most flexible and tax advantage schemes that can be provided, particularly because it can be provided through small trading companies, where some of these other schemes are really tailored to large public firms. And the way the scheme works is that you would grant an option, the employer would grant an option at a fixed price that can be exercised within 10 years by the employee. It has to be exercised in that time window, and those share options can be worth up to £250,000 at the grant date. And there's no tax charge on the employee when they're granted the share option. And why would there be? Because they've not actually received anything. They've just got the option to acquire shares, and they might decide that they don't want to acquire those shares. And the income tax charge that does apply will apply at exercise, so when they acquire those shares. But that income tax charge will be assessable on the lower of the market value of the shares at the grant date, or the market value of shares at the exercise date. Also worth noting that it takes into account if they pay anything for the shares, that would be knocked off with any income tax charge. But what that means is that if those shares increase in value between the date they were granted and the date they were exercised, well, the employee gets a tax advantage because that income tax charge is based on the lower of those values. The flip side of that, of course, is that if they sold those shares at a later time, that difference between what they've paid and been taxed on as income tax and the sale proceeds will be subject to capital gains tax. But capital gains tax is generally going to be much more favourable from a tax point, much lower tax rate. So it's good for the employee, and that's where the main tax advantage is for employees on using these types of schemes. And the great thing about EMI schemes is that they're flexible. You can apply performance conditions to those share options. So you might say that the employee can only exercise their shares if the company profits were £100,000 or more. So that encourages them to drive the business. We often see them used as only being exercisable on a sale of the company. So that sort of encourages employees to stick around and stay with the business, because potentially they could share in the future sale of the business and get some of the proceeds of that sale. But one of the best ways it can be used is as a tool for incumbent shareholders to exit the company and extract value. There might be employees in the company that want to buy in but don't have the funds to do so. If structured correctly, an EMI scheme can allow them to get a fair value for those shares, and for it to be funded by the company rather than the employees. So it allows them to sort of sell those shares to the employees, get a good price for those shares, for the funds to come from the company. Company gets a corporation tax deduction, and for the employees to be assessed on a potentially lower income tax charge than the market value of the shares at the exercise date. So it can be tax efficient all round. And if it's established early in the company's life when the shares are of a very little value, it can be really tax effective for the employees, because say they exercise, if they acquire them when if they're granted at £1 and they're exercised when the shares are worth £10, that income tax charge will be based on the £1 value. Much better for them. And then finally, I'm conscious that we are running low on time here. I just wanted to run through pay-as-you-earn settlements. A pay-as-you-earn settlement is an agreement between the employer and HMRC to, in effect, settle the employee's tax liabilities on certain benefits. So the employee effectively receives that benefit tax-free, but the employer foots the tax bill. Now, as an employer, why would you want to do that? Well, it's a gesture of goodwill, really, and oftentimes maybe perhaps small or minor benefits or benefits that aren't provided very often might result in a tax charge for the employee, and it might not necessarily have been planned by the employer. So it could be a bit of an administrative burden, especially if, for example, let's say the annual £150 per head party went over the £150 limit. And so you had tens or hundreds of employees that suddenly had a benefit as a result of the annual value going over. Well, that might be very inconvenient for everybody involved, because we've got P11Ds to prepare for all of those employees, and those employees would have to report that on their self-assessment tax return. So from an administrative perspective, there could be a lot of costs involved with dealing with that. So where the employer would prefer not to have to go through the rigmarole of all that, they might just agree a pay-as-you-earn settlement with HMRC, and that would mean that they would file one. They would have one filing to do with HMRC at the end of the tax year, and they would pay sort of all of the tax on that benefit. But probably a point to note with the pay-as-you-earn settlement is that the tax is paid on a grossed up basis. So because those employees are in effect receiving a benefit, and they are also getting the benefit of the employer paying the tax on that benefit, you do have to gross those up quite significantly. So it can be a big tax cost for the employer, especially when it covers a lot of employees as well. But the flip side is that it takes away that admin burden, especially if you've got tens or hundreds of employees that you wouldn't normally provide P11Ds for, having a benefit, and then it just takes that away with it. So something to think about when there's accidental benefits provided. And that brings us to the end. I think we've covered quite a lot of ground here today. Probably just worth noting there that no, every client has different circumstances, so the same advice doesn't never necessarily apply from one client to the next. If you do have any tax questions, do feel free to give Lewis or myself a call on the number there, or to have a look on our website, or get in touch, drop us an email. I'm sure we could probably help you out. Our next seminars coming up are for March, we've got one on private residence relief, which is quite an interesting area, covering relief on your main or your main residence, relief for capital gains tax. And then in April, we're doing a webinar on the taxation of crypto assets, which we've noticed have become a much more popular investment in more recent years. And I don't think a lot of people are familiar with the tax on there. So it could be an interesting webinar. So yeah, we've got a few minutes left before the webinar ends. Have we had any questions, Laura?
Yes, we have. So the first one is with regard to staff parking. It says, does this mean an employer can reimburse a member of staff for parking costs, for example, in the centre of Leeds? Does this mean travel to the office is not tax allowable, parking is?
I would have to check on that, but I think there would be a difference between the employer paying directly for a parking space and for the employer reimbursing the employee for the parking. That's oftentimes a bit of a crux of these benefits being taxable or not, is whether the contract is with the employer and the service provider, or if they're reimbursing the employee. But generally, if there's a parking space, if an employee has a defined parking space at work that they can use every day, the employer might have to pay for that. And there shouldn't be any benefit, I think, where the employer pays for it directly. Possibly that's not the same case where the employee is being reimbursed. Lewis is nodding, which suggests maybe I'm on the right lines there. But certainly ordinary commuting, you couldn't reimburse fuel or anything for ordinary commuting to the main workplace. That's not something that could be, that would be a taxable benefit.
Great. So here's another one. So we're considering paying for an employee health scheme, which costs approximately £5 per head per calendar month. Is this a taxable benefit?
It's obviously a very minor benefit. I believe with, and I'd have to check on this, with these types of schemes, is the cost is based on the cost to the employer, because obviously if those individual employees took out the medical benefits themselves, they might end up paying more overall. I think there's probably certain economies of scale with setting up a scheme for tens or hundreds of employees. But I would generally, medical benefits is a taxable benefit. I appreciate that it's quite a minor figure. So it might be actually a situation where the employer might want to consider a pay-as-you-earn settlement if they didn't want to go through kind of the administrative aspect of preparing P11Ds and so on for all of the employees involved in the scheme. But I'm fairly certain that would be a taxable benefit on those employees.
Great. Do we have time for one more?
We've got a minute left. I don't want to take up any more time than anybody needs. I would note that we have got a breakout session after this, so if you do have any other questions, what we'll do is we'll unmute you all and you can ask me and Lewis directly. But yeah, I think time for one more. Laura.
Great. So if we have monthly staff meetings with a meal, how is the limit of £150 accounted?
I think provided that it doesn't cover the £150, doesn't go over the £150 per year, we should be okay. So if for example you did it monthly and it was £10 per head, by the end of the year it would be at 120 and we'd still be within the exemption. The issue is where the cost overall goes over. Now it's an interesting one because we used to, sometimes if the whole cost, the one-off cost goes above 150, that's when the benefit applies. But if you had, say, 2 events in the year, the first one for £100 and the second one for £60, well, the £100 would be covered within the exemption. The 60 would push you over, so the full £60 would be taxable. So if we're talking about lots of smaller events, well then you would only pay a taxable benefit on the event that puts you over the 150, and then any others thereafter. So if you can keep the individual cost, if you could get sort of 12 invoices of £15 or less, that would be fine. If you had 11 for £15 and one for £16, that would put us at 100. Sorry, please excuse my maths there. If one of those invoices put you over the 150, then that would just be the invoice that results in a taxable benefit. The rest of them would be covered within the exemption. However, if you just had one event that was £151 per head, that whole event would be a taxable benefit. That's the way that would work. I hope that answers your question. We have now come to time. So yeah, thank you very much for everyone that's attended today. I hope you did find one or two little golden nuggets of interest there. As I say, Lewis and I are going to stick around for another 10 or 15 minutes for anybody that does have any more questions or just wants to have a chat with us afterwards. Yeah, if you'd like to stick around for the breakout session, please do. We'll unmute your mics and you can fire some questions over to us. Actually, Laura, I've forgotten how to do this. Just a second, I think we've got people petering out now, but there's still a few people sticking around for the Q&A session, which is good.
You know how to enable people's mics, Ryan?
Yeah, I've got allowed to talk on here. Just a second.
Great.
So you can do your camera as well if you want, or if you just want to stay hidden, that's fine. Just the opportunity to fire some questions over.
Morning, Ryan.
Good morning. Is that Rebecca?
It is Rebecca. Hi, good morning. Nice to speak to you. I'm not going to take my camera off because I'm sitting on my bed with my dog, and I don't think that's quite the image that one likes to give. But anyway, I just a quick question. It's probably quite obvious, the answer, but it's eluding me at the moment. When you go back to your £150, is that including VAT or excluding VAT? And I think I've probably answered my own question, because if it's entertaining, you can't reclaim the VAT anyway. So if we're looking at the costs of the company, it would include the VAT, wouldn't it? Yeah.
I mean, it's probably something that I would want to check on to kind of appease my mind, but I would think that we would be looking at the cost to the company. Yeah. So if that company is registered and those costs are reclaimable, then we'd look at the net figure. But if that VAT is not reclaimable, we'd look at the gross figure. But again, it's probably something just to dot the I's and cross the T's. I'd want to go away and double check on that.
I would imagine, probably following the principle of it's the cost of the company, it would include the VAT, so you can't reclaim it. But that would be my gut reaction. But I have to say, most of my clients don't spend that much on entertaining. The other thing was this: if you're going to have your meeting each month and include the provide food, is that a benefit if you have to attend? If it's like a compulsory staff meeting where everyone has to go? You know, I'm sort of thinking of Boris in his garden with his bottles of wine. No, I jest. But that's actually a benefit, is it?
Yeah, well, actually, yeah, I think that would probably warrant some thinking about, because really. Yeah. You have to really think about, you know, if it's something that's wholly exclusively necessary for the purposes of the business, there's an important meeting that everybody needs to attend to discuss, you know, something to do with the ongoing trade, and food is provided. I potentially, I don't think there should be a benefit there. But I think we're really, what we need to get to the bottom of is the reason for the event, and if it is you know, as a reward to the employees, or some kind of Christmas or summer party that you often see, that's when it would be part of the £150 allowance. I did when in a previous firm we did deal with a lot of contractors, and they had an annual event, albeit probably just something with their significant other, and oftentimes we would advise them to try and split the invoice if it was going to go over 150. To have one invoice that was, say, for 140, and then for the rest, you know, that would result in a benefit. So that way they weren't getting the full 150 or 170; they were just getting the excess. Because that's the way that the rules work, which seems strange, but yeah.
Yeah. Okay. Well, thank you so much. I don't want to hog your time, but I would say I find your webinars really good. I mean, they're not too technical often when you go on these courses. You know, I'm a small practitioner, and you know, after the first half, then I sort of doze off because it's just so, you know, big firm orientated. Whereas yours are always very very appropriate to our clients, and you know, whereas I mean, I have to say most of the stuff I know, it's really nice to be able to refresh one's knowledge and listen to you talking. So I do appreciate the webinars, and thank you so much.
Oh, no, thank you. I appreciate that work, Rebecca. I'm glad that that people are finding them useful.
Yes, I do. Thank you. Thank you. I shall stay on to see if anyone else has got any questions. But thank you all three of you, Laura, Lewis, and you, Ryan. Thank you. It was very interesting.
Thank you, Rebecca.
Hi.
Is that Mana?
It is, yes. Well, it's a really interesting webinar. So obviously, you know, a lot of information. Just got a question on company cars.
Okay.
If a director, it just came across, you know, a week ago. So if a director, you know, buys a car in a company, and if the director's pay itself is less than £8,500 within the company, can he first of all claim the VAT on the car if the car's in the company's name? And would it be a benefit in kind or not? I think maybe there's two questions there.
Yeah, I think there's some specific rules on reclaiming VAT in relation to company cars, and I apologise, they are eluding me right now. But in terms of what you can and can't claim in respect of VAT on company cars, I think there is specific rules that do apply. Apologies, Manaf, would you repeat your second question?
Second one was, would it be a benefit in kind if the director's pay is less than £8,500 in the company? Obviously, he's got other income from other sources, but not within the company that he's got the car in.
Yeah, it would be a benefit because they're still receiving some remuneration from the company. In terms of what tax that results into them, will obviously depend on their other sources of income. So I would say potentially some of that could be covered by their personal allowance, depending on the value of the benefit in kind. Okay. But they would have a benefit in kind on the value of the car, depending on, you know, the list price of the emissions. And the employer would have the class 1A at 13.8% to pay on the value of the car benefit. So there would be some cost involved. I think that was kind of the concluding point from our company car section, is to generally try and go for cars that are friendlier for the environment, because generally they will have a lower benefit in kind percentage, and therefore it's going to result in a lower benefit for the employee and the employer where possible.
Right. Okay. Right. So it's not, there's no rule then where if they pay less than 8.5 that you don't need to declare it on P11D then?
I don't think so. I don't think so. Again, it might be something that I could go away and have a look at just to double check, but I don't see why the reporting requirement would be waived because the benefit was not resulting in any tax. You know, I would note that P11Ds is not the only way that these could be dealt with. They can be dealt with through payroll as well. But the P11D is sort of the default method.
Okay. Well, thank you for that.
Right.
You're very welcome.
Can I just come in there a second? I remember from the distant past that I thought if you were a director, the £8,500 limit didn't apply to you, but I might be wrong. You obviously add the benefit to your salary to look and see if you go over the 8.5. But I thought, I have this distant memory that directors were excluded from that. Do you have any?
I think, and I might be thinking of something different, but it's with regards to the calculation of, there is rules that apply for directors with regards to the calculation of national insurance, because I don't know if this is the same thing that you're referring to, perhaps, but it's calculated on a cumulative basis rather than
that's not what I meant. No, it's not that. I thought that because if your total remuneration package is under 8,500, you don't have to take account of some of the benefits. But I thought that was not the case, because I think that's what our colleague there was just asking.
Okay.
I thought that that was excluding directors, but I might be wrong. It might be worth looking at.
Yeah, I think if you
Gentlemen,
leave that with
yeah.
me, man, I'll have a quick look and see if I can find a more definitive answer to on it.
Thank
It's
you. I
not
will
something
try
that
as well, see what I can dig out as well.
It's helpful.
And I don't think you'll find that VAT is reclaimable on a normal car. I don't think it is. I don't think it's a reclaimable for that.
Right. Because very strangely, sorry about this, strangely, I picked up a client and he had an Audi, which is about 60K, and previously the accountant claimed the VAT, and I was quite astonished as to how he managed to claim the VAT. And I said, you can't.
I think there are some very unusual. Yeah, I think there are some very unusual cases when you can. I think you have to be in the car trade or something like that. But I think in general you can't reclaim. Just your normal client wouldn't be able to. Well, obviously if they go to that accountant they can, but normally you can't reclaim the VAT on a car purchase. I don't think.
Neither could I. Yeah, it's a restaurant trade, so I couldn't imagine that why they've been able to claim about £12,000 VAT. So car was very expensive. But
delivery vehicle, perhaps. Being facetious. Yeah. No, I know. Well,
I've seen cases about people kind of where the car is somewhere between a car and a van, and where it falls is open to interpretation.
but not a £60,000 Audi. I wouldn't have thought.
No, probably.
So he wasn't pleased that he couldn't. So unfortunately, I don't think he came on board.
That's funny, that isn't it?
Yeah.
Probably not the sort of client you want then. Probably the sort of client you want if you find something wrong and then they won't put it right. It's not a good client. Anyway. But great. Well, thank you both very much. It's been very interesting.
Very welcome. Does anybody else have any questions you want to ask? Got a couple more minutes, I think, before we have to close. No. Okay, well, thank you very much for your questions, Rebecca and Manaf. I appreciate it. It's nice to have a little discussion afterwards. And
thank you.
And for everyone, if you do have any queries or anything, do feel free to drop us an email or a call, and we'll do our best to help.
Right, and I think we did get one question from Simon in the Shorthouse. I think in the chat box.
In the chat box.
Do you want me to read it out for you? Simon asked, as a sole trader, is it possible to claim cost of coffee/lunch/dinner with clients or other professionals as part of networking? If so, is there a limit on this?
I think you can probably put it through the company. I'm not necessarily sure if you would get tax relief. So I think, again, it's always hard with these types of questions because you're put on the spot. And you have an inkling of the answer. But it's always nice to go away and double check. But I think you probably claim it, whether you would get tax relief. I'm not so sure. With it being sort of in the realm of entertaining, which oftentimes with tax relief it comes down to being the wholly and exclusively test and what's being provided. Certainly, I'll have a look at that one, Simon. And I'll drop you an email.
That is a difficult one, isn't it? Because a lot of times, I mean, I've got clients who perhaps, are based on the South Coast, will go to London, meet a potential client, and they meet in a Starbucks and they have a drink. A lot of sort of little businesses do that. And of course, if they did that on their own, you could probably call it a subsistence. But as soon as you get another person there, it comes into entertaining. But you can't really take someone out for a drink and ask for 2 bills, can you? Looks a bit mean.
You could, but yeah, I don't know if it gives the right impression. Brilliant. Well, yeah, thank you very much, everybody, for attending. I hope you found it useful, and the next webinars will be in March and April, and if they're of interest, do feel free to pop by.
Thank you so much.
Thank you.
Thanks, guys. Take care.
Bye.
Bye-bye.